CFTC staff roundtable discussion on credit default swaps. We have a distinguished panel of participants today, and I appreciate their willingness to come here and answer questions from staff. The roundtable will take place from 9 o'clock to 12 o'clock. There's another roundtable which starts at 1 o'clock on a different subject. The objective of this roundtable is to get what I would consider to be a fulsome discussion on credit default swaps, the risk management aspects of credit default swaps, specifically the most appropriate way of margining credit default swaps when they are cleared by a clearing organization. And as you know, the Dodd-Frank Act divided the world of credit default swaps between the CFTC and the SEC. The CFTC has those instruments for which the underlying is a broad-based index, and the SEC has jurisdiction over those instruments for which the underlying is a narrow-based index and single-name credit default swaps. So I hope that in the discussion we will get recommendations on how credit default swaps should be margined in the clearinghouse. And then secondarily, with respect to those instruments that are not margined, so I beg your pardon, that are not cleared, how the CFTC and SEC should go about setting margin requirements on dealers and major swap participants, both on the security side and on the CFTC side, and what sort of considerations we should take into account with respect to setting capital requirements on dealers and MSPs on our side and the SEC side. And then finally, I hope that we can have a discussion on whether there should be any special considerations for the business conduct standards that we've been charged with writing for swaps dealers and MSPs, both on the CFTC side and the SEC side. With that, I'm going to turn over to John Ramsey, my colleague from the SEC, for his opening remarks. Thank you.
Thanks, Ananda, and I don't have too much to add. Before I forget to do it, though, I should mention that if I accidentally express any views, they are my own and not those of the Commission or any of my colleagues on the staff. And I just want to say that we're very grateful to all of our distinguished guests who have chosen to give their time to come here to discuss some very complicated issues, things that we at the SEC and our colleagues at the CFTC are being asked to address in quite a short time period. This is just one in a series of events, roundtables, ongoing discussions happening all the time between the staff of our two agencies, and we're grateful for the very productive, helpful dialogue that we've had. There's an expression that misery loves company, and we need all the company we can get. So anyway, I will. I guess start it off there. Do you want to do introductions, Ananda, or all right? Go ahead.
So let me just have CFTC staff introduce themselves. We have two on the table. One's not here right now, but Steve, go ahead.
I'm Steve Greska, and I'm with the Risk Surveillance Section in Chicago, in our Chicago office. And joining us later will be Sarah Josephson, who heads up our new OTC division within DCIO.
And then just to make one point, well, I'll echo what John said. If we offer any opinions, it's that of the staff and should not be construed as that of the Commission as a whole or of any individual commissioner. A couple of housekeeping. If you would like to talk, you've got to press this button here so that the red light comes out, and then make your remarks. So, and then this is Sarah Josephson, also with DCIO. So I'm going to turn it over to my SEC colleagues. Thank you.
I have here with the SEC staff Jeff Mooney, Assistant Director on the Division of Trading and Markets, Peter Curley, who's an Attorney Fellow, also in our Division of Trading and Markets.
So maybe we can have the participants introduce themselves, and then we can start with the questioning. Thank you.
Yes, hi. I'm Athanasios Diplas from Deutsche Bank. I'm also representing ISDA as a co-chair of the Credit Steering Committee.
Kim Taylor, CME Clearing.
Chris Edmonds, President of ICE Trust.
Stan Ivanov, Chief Risk Officer for ICE Trust.
Matthias Graulich, Eurex.
Mike Watson, COO, DTCC.
Kristen Johnson, Seton Hall Law School.
Craig Perong, University of Houston.
Wally Turbeville, Better Markets, nonprofit organization.
Jeff Gooch, CEO of MarketServe.
Jamie Coley from Javelin Capital Markets, also representing the Swaps and Derivatives Market Association.
Lynn Martin, Chief Operating Officer, NYSE Life US.
Thank you. And since our colleagues from the SEC traveled all the way from the SEC, I'm going to let them start off with the questioning.
Thanks so much. I thought perhaps we might start off with a little bit of a recap of the evolution of the CDS market in recent years, which has been a lot about the increasing standardization of those products. ISDA has been heavily involved in that effort, and Athanasius has agreed to give us a short history lesson and remind us how we got to where we are today, and maybe say a little bit more too about current efforts to further the process of standardizing these instruments.
Great, thanks a lot, John. As you just said, the effort on standardization started a few years ago. I would say probably since 2006 we have started looking at ways to improve the instruments and make them more suitable for clearing eventually. The effort obviously intensified when we started dealing with credit events. We had to come up with a credit event auction process that started back in 2006-2007 and has evolved since there. Obviously, the auction process was fundamental in order to ensure that transactions can be settled centrally and not kind of bilaterally as it used to be the case before. In order also to move towards a clearer state, we also had to ensure that any decisions market-wide are actually, again, done at the central level and not bilaterally. And as the CCP has always to be ensured that it is going to be flat risk at the end of the day. So that led to to an effort that and the protocol that we call the Big Bang, which basically tried to create a determination committee and also introduce other aspects of standardization. And that was followed by the Small Bank that actually took those changes and expanded them also to include other credit events such as restructuring. One of the most very important also changes in the contract was the introduction, especially for the North American contracts, but also for Europe, of what we call SNAC, the Standard North American Contract, which actually standardized the coupons, and we had already standardized maturities, and that basically made the contract a little bit more widget-like, and that was obviously easier from a risk management perspective for the CCP to manage these contracts at the event of default. Again, a lot of the effort, if you look at the standardization, people a lot of times have looked at the standardization of economic terms, such as coupons. The reality is that the most important standardization, I think, that we have achieved, and we actually keep striving to achieve, is with respect to legal standardization and process standardization. And that's where, for example, the Big Bang actually was extremely instrumental. The Determination Committee is fundamental. Without the ability to make those decisions centrally and have them be binding for all participants, that the framework that we try to put in place right now would not have worked. So this is obviously has already taken place, and as we progress, right now we will keep looking at newer instruments and actually more complicated instruments to kind of move the same way. So in that respect, clearly there's not actually much more to be done in that respect for indices or single names, but then we're looking to do more work on the index tranches, etc. So, but if you look right now, credit, CDS, and you compare it to other asset classes, I would say that actually we have achieved probably the highest degree of standardization in that asset class. At the same time, the asset class itself was more conducive to standardization as opposed to other asset classes such as interest rate swaps, because the needs of the participants were different and actually were able to tolerate more standardization. If you look at interest rate swaps, for example, because of hedge accounting, etc., they require a specific date. If they have a bond, they need to hedge. These needs are not the same on the credit side, and that's why we were able actually to achieve as much as we have achieved.
Thanks. Sorry, before I go further, a couple of other technology points. it may be obvious to you, but this meeting is being recorded, so you should know that. And also, please refrain from putting any BlackBerry or cell phones on the table, as they have known to cause audio interference. So. I'd like to talk about clearing, and I'm going to ask this question first of the clearinghouses are here, but then, others could please chime in. What product characteristics are prerequisites for the clearing of credit default swaps? And in particular, please discuss the degree of standardization that is essential, that you believe is essential for clearing, the availability of reliable price information, and what elements of liquidity, market liquidity, do you look for before you decide to clear products? So maybe we can start with Kim. Thank you.
Thanks, Ananda. The types of characteristics that we look for in being able to clear a product include the standardization of the terms, and by that we mean that there is complete clarity among market participants of what is being traded. So the standardization of the contracts is important. I think the availability of pricing information sufficient to allow us to provide a good representation of market price on any given day for the mark-to-market process, and also the ability to model the risk characteristics of the product on a looking forward basis so that we can appropriately assess the risk and appropriately calculate the margin requirement. Those are very important characteristics. As far as the liquidity in the market, we do look at the availability of transparent pricing in the market. We do look at the market composition. So a market with a broader set of participants is preferable to a market with a smaller set of participants. Although, please keep in mind that with setting up a risk management regime, there are ways to compensate for certain deficiencies up to a certain extent. So if there's a less liquid marketplace, you can compensate for that to some extent with a higher margin or with a different type of guarantee fund or a different type of default management process. So also we're looking for a product set where we would be able to have comfort that we would be able to access the marketplace in a crisis situation should we need to liquidate the portfolio.
I don't know it'd be much different than what Kim went through at a macro level. Everything we've done so far has been on a risk-based model. And I'm going to turn it over to Stan and let him walk through some more of the specific characteristics of both the sectors as well as the index. So.
In general, we developed a very specific rules and practices for selection of single names and indices that would be cleared. We looked specifically at the open interest in terms of recorded transactions at the trade warehouse. We also look at the number of counterparties that would participate. We have a minimum number of counterparties that would be involved in keeping positions in those instruments that would be interested in clearing. There is a minimum number of such participants. We have developed a very strong and very robust end-of-day price discovery process, which is very unique in terms of receiving prices and being able to mark to market rather than mark to model or mark to myth, the same some people typically would refer to in terms of CDS market. We believed in our pricing. On the other hand, we've been very selective, as Kim and Chris mentioned, the risk characteristics in terms of selection of specific names that belong to given sectors and how these single names would fit the initial set of instruments that we started clearing in terms of indices, because the initial launch by ICE Trust was based on index clearing services, and then we expanded to single names, carefully adding more and more names in every single sector so we could achieve a specific number of single names that could be used for potential hedging and decreased cost upon liquidation if a clearing participants default, namely providing portfolio benefits in the sense of index versus single name liquidation or unwinding. There are a little bit more technical aspects in the selection process, but overall we look at the index, the risk characteristics, the ability again to price these instruments. We're subject our selection criteria involve a very thorough backtesting and stress testing, namely, given the new instruments that we intend to clear and those that are already in the clearing services, how the new instruments will fit the overall risk profile upon stress testing, backtesting, just to see if there is any specific type of risk, correlation risk, or extreme risk that could lead to worsening to the overall risk profiles that the clearinghouse will keep in terms of their members.
Matthias.
Well, I think if you look from a risk management, margining perspective, I think a clearinghouse has or faces the same problems as if the business stays bilateral between two counterparties. So basically, we look at it from a back end. So what happens in a liquidation scenario? And given the characteristics of the CDS market, it's there are, for example, older series which don't have liquidity. So you face always the problem that in a default scenario, you, as a clearinghouse, have to get rid of the positions. And now I believe that generally everything could be cleared, but it depends on a commitment from the market participants and the clearinghouses to act in such a situation of a liquidation in the default to provide prices and to be willing and able to buy a certain portfolio or bid for a portfolio. So that would mean you need to go for an auction process. There needs to be some mandatory element of this auction process attached to it to really protect the overall economic framework.
Thank you. Now, we have two academics here who have given a lot of thought to the subject, and I'd like to invite them. Kristen Johnson, please.
Thank you. I'm very enthusiastic about the inclusion of the academics in this conversation. My colleague, Craig Pirong, and other colleagues in the Academy have been writing about the necessity of regulation in the over-the-counter derivatives market for decades, and we are enthusiastic about the opportunity to be invited into the conversation, largely because, as Matthias mentions, there are significant continuing concerns subsequent to the adoption of the Dodd-Frank Act with respect to liquidation scenarios, particularly when execution facilities or derivatives clearing organizations might be allowed in certain instances to be the recipient of federal funds in the event that there is a default of the clearinghouse. We know that our colleagues at the clearinghouses have regularly introduced significant reforms, risk management and pricing discovery reforms that have aided in the stability of financial markets. And for that, we applaud them. But we are thoughtful about the responsibility and expectations of accountability that the Dodd-Frank Act introduces for regulators. So on that note, there are some issues, at least two, that I would raise as concerns in the development of regulation for the clearinghouses. And the first is that the pricing models and the risk management models are still continuing to be proprietary models, in which case we are hoping that in every instance each of the independent businesses is effectively able to model and manage risk effectively. I think historically there has not been, as there will be, such a level of necessity for regulators to be familiar with and have the capacity to engage rigorously in a robust debate about assumptions in the underlying assumptions in these models.
I second Kristen's appreciation for having academics included in the debate. And it is refreshing to see such an open debate on these sorts of issues. I just have a couple of comments. And one comment generally is who should be making the decision regarding what to clear and how to margin it. And I think it's very important that the decision be left with the folks that have the information and have the incentive. Yeah, that's one concern that I have going forward in terms of who has the ability to decide. And I think that the kinds of criterion that Kim and Chris and Matthias mentioned here, are crucial in terms of having a good understanding of pricing in the market, having products that are sufficiently liquid. It's not a matter of contractual standardization per se that's important. That's a necessary condition, but not a sufficient condition to make something clearable. Instead, it's having the information on pricing and risk that is crucial, and having the people that are ultimately, at the end of the day, going to be the residual bearers of that risk have the ultimate authority over whether that's a risk that they're comfortable in bearing or not. In terms of margining issues generally, I just think one thing that's very important to keep in mind with all products, but particularly with CDS, is frequently there's an incentive or a tendency to think of things on a product-by-product basis or a name-by-name basis. But when you're talking about CDS, particularly various sorts of correlation risks that are very hard to understand and very hard to get a good grip on are extremely important and of first-order importance in these sorts of markets. And that's another sort of issue that I think regulators have to be particularly aware of going forward.
Before we get waist deep in a lot of the policy issues, I just wanted to ask anyone who has some thoughts about it in terms of looking at the evolution of the market and development as between index products versus single name CDS or narrow-based index. How people see that progression developing. Will the prospect of clearing change that? Obviously, from the SEC standpoint, we have a particular interest in products that can be either used as proxies or in tandem with an underlying equity. We have a concern with the whole area, of course, but it might be interesting to get people's perspective on how they see the migration of this particular part of the market developing in terms of breakdown of product types.
Yeah, I mean, if you look at the progression of the introduction of products into clearing, obviously we have started with indices because they're actually simpler products. They have less volatility, and therefore that was the natural product to actually experiment with. I would say that that has gone well, and that's why you see the success, and that the fact is among eligible participants, we have cleared north of 95-96% of most of these liquid indices. So that was how we where we started. Obviously, the next step was to introduce the single names, which carry with them more risk, and that's why the risk models had to be adjusted. I think most CCP started with kind of regular, models that have used already in futures when they dealt with indices, but obviously when we went to single names, the models had to adjust significantly. From a clearing participant's perspective, we have an interest to maintain balanced books. So to the extent that actually we trade in both indices and single names, we have an incentive to actually, for example, introduce index components into clearing as quickly as possible so that actually our exposure in and out of clearing is balanced. So that has been the kind of one of the prioritization schemes with respect to the introduction of single names, to try to look at index constituent component. So, and obviously we also started kind of, with more low volatility names among those. And that's how we're pushing the envelope right now. Obviously, some of the other names that we need to introduce, but they become more complex, is when we introduce financials. If that's where we start dealing with, and I think Craig touched on that, the correlation issues, basically. How is it basically, when Deutsche Bank trades Morgan Stanley, CDS, etc. So all of those obviously are more sensitive, and that's where a lot more work needs to take place. Just to finish quickly on the comments that people made earlier, I would also agree with them. I think all the thoughts expressed I definitely agree with. It's very important to remember, unfortunately, it's all, people say economics is a dismal science. I mean, CCPs take this pessimism to a whole new level because all we talk about is default, and it's all about default management. So all it is, when one of us goes under, what happens? So do we have the ability to unwind that portfolio successfully? Step number one is to ensure that we have the ability, we have already priced it properly. Step number two is that we have estimated the gap properly, the gap risk properly. So there is also the second part, which is the mutualization element. As we look into introducing a new name in there, we want to ensure that actually that name, for example, is traded by multiple participants. We don't want to be in a situation, for argument's sake, that is participant A, participant B trading a name, participant A defaults, and there's only one person in the whole CCP that knows how to price that instrument. So that is an example of something that would be inappropriate to clear. Second thing is we have to make a guess, and that's not a black and white decision, obviously, and the CCPs are going through this every day, obviously, is to estimate what is going to be the liquidity of that given name for the life of the product. The liquidity characteristics change significantly from the beginning when the product is on the run to when it's 1.25 years and you never see a trade. So these are kind of the, and I know we're going to get into more details later, but these are the kind of issues that we basically have to consider as we look into expanding the envelope.
Just to quantify Thanasis's point about expanding the envelope, right now we clear 89 single names here in the U.S. and a little over 100 in Europe. I would estimate that as confidence gains, as some of the uncertainty around what the rules will be and how these products work together, how portfolio margin is developed from a regulatory status, you could see that list grow. We'll use a round number, won't be correct, somewhere around 300. Maybe it's 400, maybe it's 250, whatever, over time. But that'll be something that we grow into as we get through that. But that is predicated upon clear understandings of the rules and the expectations from a regulatory status.
Yes, sir.
If I can draw some analogies from the cash side of the marketplace, the point about what's liquid today becomes very liquid tomorrow. We saw very closely when we did the Lehman liquidation, where we had about a $500 billion gross book. The positions, the treasury positions, equity positions, were all hedged out and started being liquidated fairly immediately. What was difficult were all the corporate bonds. Trying to cover a short TVA bond is not a simple process. But with the margin that we had from the liquid positions, we were safe in terms of loss protection. But it very much is dependent upon the percentage of liquid positions versus illiquid positions. And as these products come on and go through this phasing, that'll be an important consideration in terms of a high concentration of illiquid positions. Obviously, it could be very, very difficult to deal with. In terms of, there was a comment about model reviews. We are working with New York Stock Exchange Life on NYPC, and I have to say that the thoroughness of the model reviews by the regulators is unsurpassed. We have gone through hoops and multiple iterations of reviews and so on and so forth. So while there may be different approaches, as you said, it should remain with those who have the interest in the results. The regulatory oversight is rigorous and thorough, and hopefully is consistent across the marketplace. And last, I just want to address, there was a point that was made about use of federal funds. I'm not sure if you were alluding to a bailout of a CCP or liquidity, which is an issue that gets often confused. We've talked about access to the Fed window in order to get liquidity to keep the market flowing. That's not a bailout, obviously. That's a loan, usually a collateralized loan. So I just want to make sure that those two are two very separate issues.
True.
Thank you.
Thank you. If I could pick up on things that Thanasis said, which is the ability to give prices or quote prices and the ability to participate in default management. How do we as regulators, make sure that those two items or those two considerations don't become barriers to entry for people who want to participate in clearing? So perhaps those who haven't had a chance to speak could comment on that.
Hi, it's Jamie from Javelin Capital Markets. It's a good question. I would say one thing is that the market is dynamic, and as we move through time, the liquidity certainly changes in a micro context, but also on a macro context. And what I mean by that is certainly the impact of several swap execution facilities is going to help drive transparency and pricing of individual instruments in interest rate swaps, and also certainly in CDS. Currently today, the liquidity is certainly clustered around a 5-year swap point. Over time, we would expect that would change as transparency and comes to the market with live screen trading. Certainly as it goes down into the 1-year context and further out into 10s and even 15 and 30-year. So what I would say is that it becomes almost self-fulfilling. The more things that trade or are eligible to be cleared in a clearinghouse is also assisted by the multiple CEFs that then pop up and start driving and creating transparency in the marketplace. One sidebar is it's good to note that there's competition between clearinghouses. So there is an incentive, an economic incentive, for people to bring new products to market or to accept more individual names into clearing. That said, it should be balanced against a sort of a race to the bottom, such that, and that's really where, Ananda, you come in, to ensure that that balance is carefully tendered.
Thank you. I think John, too, will have something to say about the race to the bottom. So, sorry.
Yeah, sure.
We're against the race to the bottom.
Is that a personal or a commission statement? I think it's actually a very interesting question about price liquidity and default management, which Matthias raised, and how many products you actually intend to clear. Because I think the CDS markets are, in aggregate, very large, but on each individual name, actually very small. If you look at the top 1,000 single names, they trade on less than 4 times a day on average. It's probably only 30, 40 names trading even 10 times a day. And as Jamie said, those spread over a number of maturities, perhaps 30% of that's at the 5-year point, but they're spread over a number of maturities. So you're trying to clear what is, at the individual name level, a fairly illiquid market. And I think where you get a lot of debate across the industry is, how do you defend against that? So there's 2 solutions. One is to only clear the very liquid products, which can be easy access to pricing. You can run daily cycles, etc. You can be pretty sure there's enough liquidity to move the names out. Or if you start moving further down that curve, which seems to be the direction we're going, putting less liquid product into clearinghouses, I think, as Kim mentioned, there's ways of dealing with that, but that starts to force you to put commitments on individual clearinghouse members to take part in daily auctions to support pricing, commit to take part in a default situation, to take part in an auction to help move some of those less liquid names that a clearinghouse could never realistically trade out for themselves. And then as you do that, that puts the onus on the clearing members to be higher and higher and higher, which tends to concentrate you on the more professional users, the larger users, as being the only people who can realistically make those commitments. And there's certain parts of the industry that sort of complain about that in terms of excluding some of the smaller and mid-sized players. But I think that's the inevitable consequences, the choices everyone takes about how much business is going to be cleared. If you clear very liquid investment grade indices, you can probably run a very different set of membership requirements and obligations than if you're trying to include the 300th most liquid single name. That's going to be much tougher. And I think that's why it gets to be a very emotive subject, because depending on how much you try to put on, you have to deal with the lack of liquidity in other means, and that in itself creates barriers. So I think it tends to get a very emotive subject.
It's George Harrington from Bloomberg. I think barriers to entry are really a key subject in the clearing debate, as far as what are the barriers, and obviously being a clearinghouse obviously has its own challenges as far as the default management rules, but also for for all the participants who are going to be involved, whether it be a CEF, whether it be an SDR or a clearinghouse or a real-time reporting facility, whatever it may be, all of these products, especially in the CDS space, have a lot of standardized terms, as we've talked about. But with that, there needs to be access to the usage for the participants of the basic standardized information around those products, but then also open access to the to the clearing facilities. And when we say open access, obviously, I think the race to the bottom is a good point. That I think it's almost technologically impossible for everyone to say, well, I'll be fully interconnected to everyone who comes to the market in real time. That being said, for participants or major participants, I think that there certainly should be a standard set that open access, among the providers of functionality, whether it be clearing, whether it be execution facility, or a swap data repository. There's a lot of utility-like items that need to be able to be accessed at a fair level.
Sorry, go ahead, Lynn.
Oops.
Lynn and then Wally.
Okay, as the lights are going out. Thank you to the SEC and CFTC for inviting NYSE Euronext to participate on today's panel. Just want to touch on a couple of things that some of my co-panelists have mentioned today. One around the idea of open architecture. Specifically, that there needs to be a common set of core principles or a common regulatory framework that governs these things, so that we don't have a race to the bottom, so that there isn't a regulatory arbitrage opportunity potentially created. But one of the other points that I want to touch on is the migration of products into central clearing, and how, in order for an efficient migration of the products to central clearing, what needs to be considered is the way the markets trade today, and allowing the markets to continue to trade in that manner. If the goal is to migrate products into a central clearing platform, then in an efficient manner, what should occur is that the markets need to be allowed to trade as they are today, to some extent. Moving to central clearing leads to additional standardization, and that potentially could make the market models that are adopted for certain products today evolve in the future to more of central order book products. But to force the products into a central order book mechanism when they generally don't lend themselves because of the infrequency of trading or the bespoke nature of the products could potentially affect the liquidity of those products.
Sorry, Wally, you wanted to say something?
Thanks. Yeah, I think it'd be a good time to, because there's several concepts that have flown around here and need to sort of be tied together. Craig was talking about the motive for the decision-making process for including instruments in clearing, and it has to do with this is a law that depends on the clearinghouses to make decisions to for its success or failure. So what is, I believe, critically important is that the clearinghouses who offer these services do have the motive to advance the principles behind Dodd-Frank. And in thinking about that, I think it's really important to think about what the real decision-making process is about. When we say something doesn't have the risk construct to qualify for clearing, what we're really saying is that there's a decision being made that the residual risk beyond what can be collateralized is somehow inappropriate for redistribution allocation beyond the collateral to the various members of the clearinghouse. And that's what we're talking about. So it's a question of reallocation of that excess risk. And the decision between an instrument, if an instrument is going to be entered into, and cleared or uncleared, if it's uncleared, it's in an environment where all the fine attributes of clearing, like standardization, clearing causes standardization to occur, like transparent management of the risk, margining of the risk in a proper and timely way. All those things don't get done. So I think the challenge is not simply to live with the fact that those kinds of limitations are on us, but think beyond ways, beyond just putting up more collateral, beyond some of the more obvious ways to try to bring as much product into the clearing environment as possible. Recognize and not do a race to the bottom, but rather try to imaginatively think of ways that we can bring as much into the process as possible without racing to the bottom, without creating systemic risk.
Your statement just triggered something I was trying to ask generally, which is, or make a statement first of all, which is kind of an obvious one. The statute has put the regulators in the middle of this dynamic in terms of figuring out what gets cleared and how much and how one makes those determinations. And so one of the things we're going to be dealing with is trying to come up with an appropriate framework for making those kinds of decisions. As a threshold matter, for example, for determining that if something can be cleared, if it's approved by a clearinghouse and approved by the regulators, approved by a clearinghouse to trade, that product or economic equivalence must then be cleared. So I guess one question is, do we allow for bilateral trading to continue side by side for at least those class of things that we have determined commercially can be cleared? And there's a mechanism for doing it. So I'll just throw that one out as a first.
I would say that, it's Jamie from Javelin again, I would say that if you allow, and certainly there are instances where bilateral trading should continue, one has to be very careful that if you allow that, there should still be a significant impetus for the market to continue to be centrally cleared. So where we sit, if you look at the credit default market in North American credit, you see that index, which is essentially 3 or 4 products, are 40% of the liquidity on any daily basis. They are comprised of 248 constituent names. Specifically, we believe that they should all at some point be cleared. Be it 85 names today, bootstrapping 50, 60 names, over a successive period over the next 2 to 3 years, such that 248 names, or at least, are traded, are clearable. There's about 450 to 500 credits that trade actively in North America. And I think if you capture the 248 names and index, you're capturing approximately 60-70% of the daily volume in the credit default swap market today. Obviously, as you trail out from there, there are credits that don't trade that frequently. I would say that one has to consider and be mindful that volume does not mean, or the lack of volume in a particular trade or a particular name does not mean that you cannot price it. As any credit trader will tell you, it trades on a curve. So whether it be a 5-year, take a GMAC curve or Fannie or Freddie, there's thousands of issues that get priced on a daily basis. And it's not necessarily marked to myth. These are legitimate prices where traders put risk or balance sheet at work every day as they provide liquidity to the market space. So I would be mindful that over time, the market should drive towards clearing. And to the extent that you allow or there is a necessity for bilateral trading to occur, you should somehow handicap it with some type of capital, the appropriate amount of capital to, as an incentive, let's say, to ensure that there's no gaming of the system such that names unnecessarily sit outside the cleared context.
I would like to take a second to explain what we have in place in terms of trying to mark contracts and why we have made those choices. And I'm following up on what Jeff said earlier. If you look, even if we had made a decision to just go with the most liquid instrument out there, which is the on-the-run investment grade index, that liquid, as we know, it can trade 1,000 times a day, but in about 6 months' time, when it becomes off the run, the volume will drop by 90%. In another 6 months, that volume drops practically zero to a few trades a day. Okay? So that is why, even if you start with the most liquid instrument, it will become illiquid eventually. It's the aging process. Unfortunately, we all have to go through that. So so we have to have the confidence, however, that we mark this thing properly. And the mechanism we have introduced is actually quite a stringent one and onerous, perhaps you might say, but it is fundamental. If we look at the curve, and then we go back to single names, when we talk about a name trading 10 times, it means there are 40 points on this curve, and there are 10 trades in one of those 40 points. 5 of them are most of the time on the 5-year. The other 5 get distributed among the rest of the 39 widgets. So what do? We will not observe this, and as James said, we have to price some of these things on the curve. So what we do, we have put an obligation on the clearing members to basically give two-way prices, which can be actually executable two-way prices, in order to give the confidence to the clearinghouse that they know what that market is. Because remember, even if it trades on a SEF, the 5-year might trade, but you will not see the 2-year. So, just to give an example, if everybody says on a given day they mark the 2-year at 99 and 101, i.e. the mid-market is 100, and I say I'm marking 199, 201, I'm off clearly, either because for some malicious reason or because I don't know what's going on. But what happens is, in that process, I get penalized by a cross trade. So that's why I have to basically take that responsibility to take that trade on. Now, the benefit of that process is that it introduces honesty and information into the process. And then next day also, my manager will know that actually I don't know how to mark this thing. So probably they will tell me to actually go fix it. So that is a process that creates a virtuous cycle that to actually give that information. So that's what we have put in place. Now, that, as Jeff said, is a very onerous process. So whoever is participating there has to stand up and be subject to that process. And that's why I said that if there's only 2 people doing that, clearly that's not good enough. It's going to fail. We need to have a minimum mass of people actually trading this thing. On average, we have looked, and I'm looking at the CCPs here, we have wanted to have at least 4 people that actually provide prices in that scenario. So that's kind of a number, but I have to be careful. We have to be careful that this is not going to go away. CEFs or no CEFs is not going to go away. CEFs will not create liquidity beyond what clients have to do. The needs of the clients are what drives the liquidity. And if you think of clients, I would say think of them in two ways. There's the people that actually are the frequent traders that will trade around the 5-year. That's why you see so much of the volume of the 5-year. They always want to trade the active contract. And then there is the others that basically they're the buy and hold customers. They will buy, they hedge a bond, and they buy CDS with it. As the bond ages, the CDS age. So those guys will never trade it. But then we need to price, remember, everything in the clearinghouse. So that's the last thing. Keep in mind, this process has to be strong, and whoever comes in has to stand up to fulfill that obligation.
I fully agree.
Let Kristen want to say.
Thanks so much. I want to go back to the original question that seems to be on the table in that with respect to what we can determine based on what the CCPs regularly clear to be eligible, there seems to be a question about whether regulation mandates, whether we interpret Dodd-Frank and read the congressional statute to mandate clearing of those instruments. And I think there's a parallel question within the eligibility and ineligibility discussion. And let me explain what I mean by that. It was Lynn who mentioned that there would need to be consistency as to how we treat, how the regulation treats the various clearinghouses and examines them. And there will be real challenges here because as the CFTC and the SEC come together to attempt at some form of harmonization, there are historic principles versus rules-based questions that will arise here. And so in looking at the question of the requirement for clearing of what the market has deemed to be eligible names or eligible indices or other products that clearly the CCPs are regularly clearing, I won't resolve here whether there is a mandate that those must be cleared. But I think that there should be some concern about what the congressional intent in the statute was. And in sorting that out, however it works out, I would just echo Lynn's comments that there would be some consistency with respect to margin and collateral setting, with respect to clearing those trades as per what the CCPs are doing for those specific transactions, right? So I think one of the greatest overarching concerns was the shadow trading of things whereby pricing might have been inaccurate and margins and collateral requirements were obviously inaccurate. So allowing eligible transactions that the CCPs have clearly established in the market that they are willing to clear, allowing those eligible transactions to occur outside of clearinghouses does leave an onus on the regulators to be very active in assessing margin and collateral requirements, and it creates a market surveillance, it creates a gap in market surveillance, I believe, based on the reality of the human resources available at the federal regulatory level to oversee on a daily basis the mark-to-market evaluation of those transactions that are not cleared.
I believe there is a mandate, but it's the fact of the matter is that the meaning of Dodd-Frank is that as much as can within the bounds of prudency be cleared should be cleared. I think that's obvious from, didn't say clear, that's obvious from the statute, and I think it's clearing is a remedy to a problem that was viewed as in existence. As to items that aren't cleared, it also suggests strongly that the process of clearing and the ways to manage the consequences of default are a superior way of going about things than in a bilateral world. Ergo, while clearing processes suggest the right kinds of approaches to measuring risk, that in an uncleared context, particularly with regard to liquidation of positions, the appropriate amount of collateralization should be in excess of that which is required in clearing, because conceptually it's a different world in the resolution of a default, and it's not as inefficient and as a process-oriented process.
And I suppose that if one accepts as general proposition, the idea that there's a mandate that if something should be cleared or can be cleared, it should be, to Athanasius's point that he made recently, that, products can have a life cycle too. And so, market demand may ebb and flow. You may have a product where there's enough market demand at one point in time that there's that would justify even mandatory clearing. That might not be true in perpetuity. I would assume there might be a point at which that mandate might no longer survive or be appropriate for that particular product. Which I suppose if the clearinghouse no longer has the demand, it would could stop trading the product, and then the question, I suppose, would be: does the regulatory mandate then fall away? Anyone?
I don't think we can declare, actually. The reality is if we put something in the clearinghouse, it's going to stay there. It's very difficult to declare something. So we think we need to make that decision once, and then it goes there. And then it's going to stay till it matures.
Yes.
If that's what you're... Sorry.
I would agree with that, Thanasis. I would agree with that, Thanasis, that trades, once they are cleared, would be difficult and probably unproductive to unclear positions that have been cleared or to force those to be uncleared. But I think that there could be a circumstance in which a particular product was cleared for a period of time, and then the clearinghouse could determine that the service for that product would be extended only to liquidating trades or something like that. I think it would be unlikely. So I think we should be making good choices on the way in. But with respect to the question of whether or not everything should be forced to be cleared if a clearinghouse makes a service available, what I would say is I'm not the right person to evaluate whether there is or is not a mandate in the legislation. But I think that the markets are best protected, and the participants and the system as a whole are best protected when the structure that we put in place is one that maximizes the amount of available liquidity. And so I would suggest that to the extent that there is room for flexibility in the regulations, that the regulators would follow a policy of trying to kind of first do no harm. And over time, I think the existence of the CCP model and the existence of the CEF incentive will tend to increase the available liquidity and the visibility of that liquidity. That's not something that's going to happen automatically overnight. And so I think there will be a transition period during which we should think very carefully about doing the transition to clearing or to CEFs in such a way that there's the least disruption possible to the available base of liquidity that exists.
So liquidity was mentioned many times now as a key criteria whether a product is clearable or not. And I fully agree with what Thanasius said, and this is a built-in problem with the indices, with the old series. So if you have a new series, the old one will become illiquid, so it's difficult, and there is no liquidity in a default scenario for those products, so you as a clearinghouse are not at all in a position to liquidate those positions of the old series, because there is no natural market liquidity. So and what Thanasius described, the mechanism which is introduced now, that the market participants who are in a position to do that are, well, voluntarily providing prices to the clearinghouse to do a proper valuation of those positions is very important and is one piece to the puzzle. I think if it comes to the liquidation, then it is important that the dealers who provided the prices stand by their prices. So they have to have, if that system should fly, then they have to have a certain obligation to stand by their prices and pick up some of the portfolio of the liquidating of the defaulting member of course with some discounts reflecting the size of the defaulting member and some spread increases, which you usually observe in a default scenario. But I think that is something which needs to be added to that approach, what is currently there. An alternative, I think, and if we look at the Lehman default and how Eurex, which is predominantly exchange trading, so here you have the future system that you always have the high liquidity in the closest 3-month expiry, and every 3 months there is a big roll into a new series. And I didn't think it fully through, but perhaps that would be something which could be an alternative way to make those old series illiquid, but kind of roll those old series into a new series, which then has a liquidity again. I don't know. I'm not a market expert, and Thanasios or others can comment better on that. But that could be an alternative, having seen that it worked on the future side very well.
I would add to that is that it kind of happens already. That's what I was saying. Half the trades, let's say, roll, but then you have the problem that the other half. I'm making up the half, but more or less. But the others don't, and they basically age. And the advantage of futures, you're very correct, is that they actually naturally expire, and therefore you never have the aging problem. So that's the thing. There's only one word I would correct in what you said. I agree with everything else. We don't voluntarily provide prices. We contractually provide prices. And also for default management, we contractually have to step up, exactly as you said, to actually take and unwind the defaulting portfolio. In every other respect, I agree with you.
And just to expand on what Thanasis is mentioning, indeed, our participants, they provide prices. These prices are such that they stay behind them. Actually, we created something we feel that it's almost unprecedented in the CDS market, namely having a price discovery process that provides prices at 9 points on the curve, even though typically people would look at the 5-year point as the most liquid. In terms of managing default and rolling, it is about risk management policies and practices and how risk management is executed. But once a series rolls or just moves from the most liquid point, definitely the liquidity charges would and should and must increase. On the other hand, in terms of default, the default management approach is to really look at hedging with the most liquid points on the curve and then auctioning the full portfolio rather than just sitting on these illiquid positions that are very difficult to move. But the price discovery process is indeed very robust, and we've seen tremendous improvement in terms of market consensus and prices that we generated throughout the last 16, 17 months in terms of index and single name pricing.
Correct me if I'm wrong, but I think what I just heard was, I think, a very sort of interesting point. As the liquidity deteriorates in this set of instruments, what's happening is that a set of the participants in the clearing enterprise, the members, are actually providing liquidity at a price in order to support the credit system that's in place. Okay, that principle is the principle that I was talking about earlier, which could very well, I think that's a tremendous result. I think it's a sensible result. It's a way to increase the amount of instruments that can be cleared, and I think it has applicability far beyond that specific situation in terms of instruments that maybe cannot be clearable given the judgments that are applied by clearinghouses at the outset. It's a principle that can be built on and used to actually fulfill what I think is the intent of Dodd-Frank, which is a mandate or to clear as much as you possibly can.
There's one other element we kind of forget here. We're in the trade information warehouse. We have 3,000 reference names. So there's two elements here. There's an element of the maturity curve, but there's also the element of there's a lot of names out there that were bespoken or one-off type of transactions. So that factor in terms of everything getting cleared, there's another part of the depth of the market that has been taken into consideration. The comment about the lack of standardization, I think, as Thanasa said at the beginning, there's been a huge move towards standardization. 98% of our transactions are gold transactions, electronically confirmed, and you do that because of standardized terms. So regardless of what's going on in the clearing space or the CEF space, at the end of the day, obviously, we've been a very strong proponent of standardized reporting and aggregated reporting, so there is transparency. There is a single source of information that the regulators and the market can go to. So the lack of something being clear does not inherently mean it's not standardized, not reportable, somehow disappears into the ether of Wall Street and never is seen again. The activity is standardized. The activity is being reported upon in both a public manner and to the regulators.
Now, to counteract declining liquidity, is it appropriate to have a ratcheting up of margin requirements and/or default fund requirements? Because after all, one of the concerns about the liquidity is what happens if somebody defaults and how do you manage that position? So I'd like some comment on that.
It is appropriate, but it's already done, actually. I mean, the CCPs themselves, I'll let them explain, they already have, they look at the bid offer in the market, and based on that, they basically determine, based on the depth of the market, what the right liquidity charge is, basically. So as the index, even an index that is liquid now, ages, we do pay higher margin and guarantee fund contributions. So that's already done, and I think that's the only way you can deal with it. Remember, the margin has to reflect the gap risk. The gap risk is higher for a contract that's more illiquid. So I think they're doing that already. So conceptually, the framework is correct. It's a matter, we can discuss the calibration, whether they do give the right numbers or not, but conceptually, I think they're approaching it the right way.
That's also going to be, it's going to impact the liquidity charge, but it's also going to impact the concentration charge, right? So the concentration charge is going to be based on how much you can move compared to the size of the position. So it should be factored in.
I think you almost have to give the CCPs a little bit of wiggle room to make their own decisions on some of this stuff. Because I think if you look at the indices at the moment, as we roll an index, we take 125 names and we decide that only 110 of them are still very liquid, and that's the new index. So if you look at an index from a few series ago, most of the names within that index are still liquid and are still actively traded in the new indices. So whilst the index, the package itself is illiquid, most of the risk it contains is still liquid and can be managed. But you could get a situation where radical movements in the global economy and the names change very fundamentally. So you could end up with a very old index that has nothing in common with current single names that are liquid or current indices, and that would be a very different risk management problem. So I think it's very hard to draw a general solution. Most indices themselves age gracefully and change slowly over time, and whilst they're illiquid, what they represent is not that illiquid. But you can't always guarantee that in the future. So I think there has to be some sort of let out for the CCPs to, if they're left with a situation of something that doesn't trade at all in any format, then there presents a different set of solutions.
Yeah, except, Jeff, the one thing is, while the names themselves, at the current on-the-run point will continue to be liquid, the names at the same maturity as that off-the-run index, rolling down the curve, are going to get less and less liquid.
Yeah, you certainly get a double factor of liquidity. You've got the aging and the fundamental liquidity in the name, I agree.
Yeah, I think I was going to bring up the same point that Tom did, but, think about concentration at the end of the day. There could be positions that are in the clearinghouse that someone pay whatever it is they need to pay in order to terminate that transaction. It goes away and there's no longer any risk. That could definitely change the concentration profile of who holds the positions left in the residual contract or position within the clearinghouse. That change at the end of the day, we're going to monitor in real time. I'm sure any relevant CCP would do it in some similar manner. But, it seems to me like there's this idea that we don't want to clear more. I mean, we're commercial interests. We have shareholders. We want to clear as much as we possibly can clear at the appropriate time. The balance of risk that we have is making sure we do it prudently, so that there's not a desire here to go, gosh, we only have 89 single names, or 300 or whatever. Can we get to 3,000? I'll defer to Stan on that one. But it is something at the end of the day that that is the motivation about the structure of the commercial entities that provide these services. That if we were to begin, and there have been some comments around whether or not these should be more utilities versus for-profit entities, it's problematic, because if you make that a less than a for-profit utility, you may end up with a situation where there is no motivation to go out. It's not the race to the bottom, because you still have the balance, and it's incumbent upon the regulators at the end of the day to make sure that we don't do that as an industry. No one wants to sit and run a clearinghouse to manage the biggest default and not survive for the first time in history. And no regulator wants to sit in their chair going, guess what? It was on my watch that that happened. So, I mean, there is some intrinsic piece, and certainly the counterparts, whether, trading counterparts of the market or clearing members don't want to be part of that either. So there is an opportunity for, in the right spirit, but it's not something that we want to clear less, and that shouldn't be the presupposition people operate with.
Your question, there was a question I was thinking of maybe saving for later on, but I'm tempted to ask it now in terms of this trade-off between providing access, both in terms of the amount of cleared products as well as access to participants versus sort of good risk management. That's part of what the statute requires us to think about, and both of our agencies have recently put out rules on that point, on dealing with conflicts of interest and dealing with them by proposing specific requirements in terms of limitations on ownership as well as board composition for those agencies in order to try to balance those two two factors as much as possible. We are in the public comment process with respect to those particular rules. So if people have any general thoughts about that trade-off and how to approach it, or any more specific comments on those rules, I'm from a regulatory perspective, we'd be happy to hear them.
So I would say that, first of all, I think there are a number of different sets of conflicts of interest you have to worry about. So to the point Chris mentioned before, and I don't think this is a problem in any of the current clearinghouses and their current constructs, but there's, the structure of a clearinghouse is you have now private for-profit entities that are basically managing the capital of the members, because it's the members who put up the majority of the capital. Even though the CCPs all have some stake at risk, it's really a sliver compared to the pool put up by the members. So you have one concern, which is, they're basically earning fees by putting members' capital at risk. So you have to sort of watch that. From a member's perspective, I think the way you have the ability to watch that is you have some say over how your capital is risk managed, and that's through the risk committee. Now that's not to say that end users shouldn't have transparency into that process and a say in that process, or independence, but I think it's a dangerous situation. I think you have to think very carefully about saying you're mandated to clear, you're putting your capital up to be managed by this clearinghouse, and we're going to reduce your ability to impact the risk management of that. I actually think from a risk management perspective, the members are aligned with trying to appropriately risk manage that.
I would agree with what Tom said, and perhaps if I can say the same thing in a little bit more, in a slightly different way. If you look at the traditional corporate capital structure, you have the equity holders and you have the debt holders. That's a very simple structure. The equity holders make decisions, but they're on the hook because on the moment there are losses, they will be the first ones to take a hit, and then the debt holders take a hit, and usually they build some covenants to protect them, etc. In the CCP, that order is reversed. Okay, if you look at the waterfall, the default clearing member takes the first loss, then there's a thin layer that the CCP takes a loss, but then it's the debt holders that actually get wiped out potentially completely, but the CCP could still operate. So that reversal of that capital structure is very fundamental, and the way you can protect the interests of the debt holders in that respect is to involve them in the risk management decisions. And for us, that is the risk committee is the most important element of the clearinghouse to make sure we get right. And I believe in every other respect the interests are aligned. And the last thing is in terms of alignment of interest, like Tom said, is to ensure that you have to ensure that you don't have a CCP, new CCP, none of the ones on this table. Let's say you make up a new one, comes up, I'm going to clear this new product, nobody else clears it, and then you have to mandate everybody to come to me. You cannot have a captive marketplace, basically, in that respect. So again, it's up on the regulators to ensure that that doesn't happen.
Professor Perong, I think.
Yeah, this debate has frequently been framed in focusing on conflict of interest, but I think it's more important to focus on alignment of incentives, and I think that that's the point that's being made here. And there's also an issue with membership and access to the clearinghouse and things of that nature that's very important. I mean, there's also been a focus on sort of the product-specific nature of default risk, but essentially default risk depends not just on the risks of the product, but also the risks of the firm that has the position and the interaction between those two things. And when you have potentially very heterogeneous membership of a CCP, and you're essentially not adequately taking into account the specific risks associated with a particular member, that can lead to conflicts within the exchange or within the clearinghouse, governance issues, governance conflicts, and also essentially inefficient allocation of risk across the members. So I think that these access, membership, and governance issues are very important and will really determine how well this mechanism works to reduce the kinds of risks we're concerned about.
There's no doubt that everything's been described here is absolutely true, but it's a two-edged sword. I have no doubt, and I think many have no doubt, that there have been instances, I've been involved in instances, where the membership of clearinghouses, especially in launching a new product, is tremendously influential in how it gets launched, beyond merely concern about the risk of the clearinghouse. It happens. And I think the other thing so the governance issues are very relevant. Even if nothing ever had happened, just for appearance's sake, and I think for the credibility, because clearinghouses now are an instrument of policy, whether you like it or not. It's happened. It passed this summer. The other thing that's quite important, the governance issues, but you're right, is the risk committee. And I think very significantly, again, even if you're just concerned with appearances, I'm concerned with substance, but appearances, that independent representation on the risk committee in a robust form is a very good thing. That's not to say that members of the clearinghouse shouldn't have a lot to say about how that works. Their capital is at risk. But this is an instrument of policy as well, so that robust representation on risk committees is essential.
If I could chime in just with some specific corporate governance concerns that come out of a lot of the academic literature and study of securities regulation over the last at least decade, certainly strongly influenced by Sarbanes-Oxley. And in addition to that, the number of acts Congress adopted in the financial crisis, there clearly is a new federal focus on corporate governance for all types of businesses. But with respect to risk management governance, involving businesses that are effectively the arteries or nervous system of the national and international economy, I think there are genuine issues that we now find ourselves facing. I'm going to speak to some specifics because I think this is an important opportunity for what has been in legal academia a conversation we've had to bring to the table. With respect to corporate governance, in the CCPs or derivatives clearing organizations or CEFs, however we look at it, there are it is tremendously critical, I guess I should just say, that independence with respect to directors, and perhaps ICE has some unique structural benefits built in its direct oversight, regulatory oversight, making it distinct from other CCPs. But in general, the independence and competence with respect to risk management oversight on boards of directors is increasingly important. And we've highlighted independence historically, but I think we see now some new ties to expertise in the ability of independent directors to oversee risk management policy decisions and to have authority to pass on the quality of those decisions, inclusive of the effectiveness of the models, to consider highly significant but low probability events with respect to default. In addition, I think with respect to the risk management committees, there will probably be I expect coming out of the regulation, if not in this instance, then I think the academic world certainly anticipates it, requirements with respect to independence by service of risk management committee members. And this is to isolate or potentially evade concerns regarding pressure on those committees to respond, just as someone has mentioned, to new product requests in a manner that might prioritize profit over over what would be a protective or defensive position for the business itself. In addition to that, I've certainly seen in literature a number of commentaries about ties between compensation for directors to the performance of the CCPs, and some concerns about how those linkages might create cause for concern, and certainly fall within the general parameters of the conflict of interest discussion. There are also concerns about eligibility of clearing members, as Craig mentioned, that we are at least very thoughtful about, and we're sure that the CCPs themselves and the regulators as well are thoughtful about.
I would like to, if I may, just step in and echo Craig and Kristen's comments. The fact is that CCPs, are an instrument of policy in a post-credit crisis world. If clearing is going to be successful, and despite the fact that you're putting capital at risk as you contribute to the funds, the fact is that you do need a certain degree of transparency in a corporate in the governance level and access. You need to have independent directors. We need to know what's going on as a marketplace, away from simple profit motives of a clearinghouse. And to dovetail off that, I think it's important when you look at FCM eligibility requirements specifically, that the market or the CCP itself should not just focus on its FCM membership today, but also ask yourself, well, what other FCMs out of the 50, 100 odd FCMs do qualify from a capital standpoint, and who can also share the burden in terms of providing prices and putting their capital at risk in a default scenario. So especially in light of the fact that you have a certain degree of correlation risk that may exist if you just pick from one pool. So there are FCMs out there today whose core business is clearing, who represent large, away from the clearing of CDS, in other market contexts, represent well-capitalized or are well-capitalized entities that fulfill the specific capital requirements of both ICE and the CME and Eurex. But we need to be mindful that they be given access and innovative ways be thought of, because some of these guys don't necessarily have their own dealing desks, but they can still provide prices in the end-of-day process by doing joint ventures, for example, with dealers who don't clear for themselves, for example. So in essence, from a clearing standpoint, yes, you are a private enterprise, but one thing we need to be mindful of is you serve a public need in the success of clearing and the lessening of systemic risk.
I think Jamie makes a good point there. One of the things that we're seeing as far as a structural change in the marketplace right now is the move from just interdealer clearing, which has been going for I guess over a few years now on products like ICE. But then if you look at the interest rate swap world, where there's been clearing in the dealer-to-dealer market in interest rate swaps for a number of years, the structural change that's taking place is bringing the clients to the table as far as allowing clearing in the client-to-dealer space, the buy-side to sell-side space. And that's where the access points really start to obviously multiply, and the importance of it really increases. And I think Chris commented on, as far as the utility nature, I completely agree that having utilities in place will most often decrease innovation, decrease efficiency, but the keys to getting directly to a clearinghouse, getting directly to a CEF, or getting to a swap data repository to get things like data or end-of-day data that provides transparency to the market. That's where the issue, really lies. So while we've seen, CCPs in the OTC derivative space for a number of years now, the data that's out there is almost, is very difficult to gain access to, and that's what I think the larger community is really seeking, is the ability to view that data, or even to participate. So actually getting participation into those CCPs is sort of what people are looking for.
Lynn, and then
I just want to make a couple of points. Number one, it's our belief that numerical limits do not necessarily tie to voting rights on the board. So hard limits don't necessarily represent the voting rights. When you think about the governance of exchanges, DCMs, DCOs, what's more important is to take into account the views and give an equal voice to those views of different market participants. So give a voice to the independents, give a voice to the dealers, give a voice to the buy side, give a voice to the exchange management, and have that be equally weighted as opposed to have hard numerical limits governing that. In order for us to facilitate a smooth transition to central clearing, which is the key objective here, what's going to be most important is that we work together, that the exchanges, the market participants, both the dealers, the buy side, as well as the independents, all work together to define principles that will facilitate the efficient migration.
Sorry,
Yes, please go ahead.
as the representative of the benevolent monopoly in the marketplace, a couple of comments. One, I do take umbrage that utilities aren't innovative. I think we have people who are pushing the edge in terms of systemic risk and taking on issues that others have not taken on. So I'd love to have you come by and talk to us anytime you want, and we can explain some of the things we're doing that are very unique, such as the Trade Information Warehouse, which was created out of the industry working with the utility to create something that was incredibly innovative and has really spawned the growth in this marketplace. I think the comment that was made, as everybody knows, we are primarily user-owned. We do have independents on our board now. But there is this interesting tension between the alignment, as everybody's talked about. We have members, we have owners, we have boards, we have management, we have governance. And as the point was made, none of us want to have our name on the biggest default that ever occurred. None of us slept for many days when Lehman happened because none of us wanted to be responsible for the collapse of the financial markets. So there is an alignment of interests, but there's also a tension. There's a massive tension between our directors, who happen to be, as I said, primarily Wall Street firms. They have a very strong interest, again, of not seeing us fail. So we may be an at-cost utility, so we may not have the profit motive balance that my colleagues on the ICE and Eurex and CME may have, but nevertheless, I think people, when you get into the CCP space, yes, there are profits to be made, but more importantly, there is a role to play, a policy role to play, that is felt up and down the line. So you either are aligned to do your job properly, or that tension comes to the forefront very, very quickly, be it the regulators, be it the governors, or be it the members. None of us want to be involved in a collapse.
I'd like to ask a question about processing. What improvements have been made in trade processing and reporting to repositories, and what more can be done, do you guys believe, to the CDS markets?
Do you want me to pick that one up? I think, trade processing for CDS has come an enormous way over the last sort of 5 years. When I think, it first came to sort of public forums and regulatory forums, we used to spend weeks confirming trades, enormous manual processes, backlogs. We're never allowed to use that word, but there were backlogs and piles of paper on desks. It was extremely unpleasant. I think what the industry's collectively done over the last 5 years is moved to a situation where a lot of the basic problems in processing have now been solved. We've got, over 95% of all the trades being electronified on the day, being confirmed on the day, pretty much higher rates for the interdealer business. So predominantly now in the CDS market, we do have electronic records, we do have trade date processes, which, I think put us in a much stronger situation than we were historically. The focus of the last couple of years has really been two things. One is looking at that gap of some of those very complex transactions that can't be electronified easily and making sure they're still available for regulatory reporting. This is something called the bronze record process, but there's been a lot of work to make sure that the Trade Information Warehouse that the Mike runs has 100% of the credit default swap market, not 98 or 99, because it was the 1% that hurts you at the end of the day. So there's been a lot of work to make sure that everything's available. So I think we are now in a situation where, for a regulatory perspective at least, you can go in and look at everything that's been there. We've done a lot of time in this work. Where people are now sort of focusing is saying, okay, what are the residual processes which still create delay or risk? And We've done a lot of work on novation consent over the course of the last year. That was a process that's still very separate, handled on emails and Bloomberg messages and things, and that needed to be electronified, so that's been worked through. People are increasingly focused on allocation delivery from funds to sell-side firms, because that's something that does create delay. It's probably accountable for most of that few percent that doesn't go through on trade date. I think we're probably in a situation now where the trade date process works very effectively to agree the bilateral trades on the day. Where I think we need to go now is two things. One is to look at the whole clearing process. We're in a situation where inter-dealer clearing happens 5 days after the trade, and that's something that people are now working on to try and fix. Making sure that everybody has access to those processing solutions, because I think as buy-side firms want to clear, clearing brokers are getting involved with historically not been connected. Some of the new firms that Jamie mentioned getting involved in this market that have not historically been involved. That network is growing from 2,000 sort of touch points now is growing very rapidly to include all those new participants to make sure they have access to those solutions. And I think that's very important to give those guys, low-cost access is unbundled from other products and services. They can uniquely decide which clearinghouse they want to work with, which CEF they want to work with, how they want their trades processed. They're not forced into making decisions based on how those services are bundled up between CEFs, CCPs, data companies, other things. That's important. And then some of the post-trade activities. I think the thing that makes credit default swaps hard, everyone kind of says, well, they're a complex product compared to interest rate, and they're a very simple product compared to interest rate. On the trade date, the trouble is post-trade date activities, credit events, restructuring events, and there's been a lot of work through ISDA to try and standardize the way they're processed. And I think that's probably where the residual risk probably still sits.
I would agree with that. I think the asset class has been electronified more than any other asset class right now. So anything we change right now will be marginal. What is going to be the next big change, in my opinion, is as we build the CEFs, is the connectivity between CEFs, CCPs, and FCMs. Those pipes are not in place because since we don't know, the big piece of the puzzle that's missing is the CEFs. So I know you're going to have to go through a pile of applications, I don't know how high, but and then when that is in place, we have to build those pipes, and that is fundamental. And I think we need to work together, both as we've done before, industry and regulators, to ensure that we actually don't kind of rush this job. It's very important we do that infrastructure right, and because we have a unique chance to actually kind of wipe the slate clean right now and do it properly. And I think in the past we had rushed things, and then we had to go back years later and fix them. And I think now is the chance to actually make sure that connectivity is done properly. I agree that it should be, we have to build multiple access points and everything else, and we're all for kind of equal access. So in every other respect, I would agree with Jeff, but I think this is the biggest challenge we're going to have over the next few months or year.
I would just,
if I can just add on Jeff's comment about life cycle events, which I think particularly for credit is pretty important. Prior to having the trade information warehouse, you would have everyone sort of processing life cycle events themselves. So when you had a credit event in one index and it dropped down, everyone would come up with their own factoring. Bloomberg would come up with a factoring, and it would take about a week to 2 weeks before everyone's factoring got sorted out to the right decimal place. So one of the benefits of the trade information warehouse for credit is you have one place that's handling and the processing of all these life cycle events, whether it's successor events, credit events, whatever it is, and that's particularly important for this product. And I think if that does get broken up, then we've got some other work to do around how to coordinate across that.
Ananda, if I may, I'd like to just echo Athanasius' comments in terms of CEF connectivity. One thing is it's true, we should have real-time, and some CEFs actually are building or currently have real-time access to clearing. It should certainly be agnostic. It should certainly be fast and low cost. One of the things, and it's interesting listening to Tom and Athanasius talk about the post-acceptance to clearing concerns and event processing after that trade has occurred. One of the things from a future CEF that we're looking at right now, which I think requires market and industry focus, frankly, is what happens from the point of trade to the point in that period between trade execution and acceptance into clearing. And Athanasius is completely correct. What we're looking at, and we're beginning to have conversations as a future CEF today, is considering the role of CEF connectivity to the FCM on a pre-trade clearance basis, such that, the notion is you take a trade, you offer anonymous execution between two parties, you submit both the buy and the sell to the CCP on a symmetrical basis, which is currently the workflow with the CME, for example. What happens if one side, the FCM, declines the trade because, for whatever reason? So what do you do then? Does the CEF step in to guarantee the trade? We would prefer not to. So how do you get around that? And the good news is looking to other markets, there is technology today where you have, and advances in the listed derivatives marketplace, for example, where you have where the CEF or the execution broker in that context has real-time connectivity to the FCM, such that when that customer comes in to trade either on an opening morning basis, on a clip size or total notional for the day, duration adjusted, for example, within the CDS context, that counterparty, that there's sanctity in that trade, that both parties know that that trade is going to clear. And you can do that today by bringing in this greater than tangential but direct relationship between the FCM and the CEF for that connectivity. I think over time you can get to real-time connectivity such that in the few milliseconds that it takes to buy or to lift an offer off a screen, you've already queried the CEF to say, yes, no, does customer A have the ability to pay for that 100 million IG-15 trade?
I think we're going to take a short break, 15-minute break. Unfortunately, there's just one restroom, one for men, one for women. But if you took the escalator downstairs, if you walked out and took a left turn, I think there may be another bathroom over there. So 10:45, please. Thank you.